Welcome to the Deep Dive, the place where we cut through the noise of earnings season. Today we are digging into Alliant Energy Corporation, that's ticker LNT, and their really fascinating Q3 2025 earnings call.
Fascinating is the right word.
It is, because if you just glance at the headline numbers, you might just scratch your head. Look, this deep dive isn't really about the minor variances in their quarterly report. It's about a massive, and I mean massive, strategic shift for a regulated Midwestern utility.
Yeah, these companies usually move pretty slowly.
Exactly. The whole story here is LNT turning itself into a data center-anchored growth platform. That's the narrative the market bought into, and frankly, it changes everything for this company.
It absolutely does. And our mission today is to, synthesize the three big pillars from that call for you. First, the actual financials, which were, let's be honest, a little mixed.
A little, yeah.
Second, the huge increase in their guidance and their supersized capital plan. And finally, and maybe most importantly, the regulatory side of things. That's what gave the market confidence.
Okay, so let's start there with that mixed results snapshot for Q3. It wasn't perfect.
Not at all.
The company reported ongoing EPS of $1.12 per share. The street was looking for something closer to $1.17, maybe $1.19.
So that's a clear miss. You're talking 4 to 6% below consensus. Normally, that would send a utility stock down.
Right. But then you have the revenue side of the story,
Which looked really strong. Revenue came in at about $1.21 billion. That's a solid 12% year-over-year increase.
So what drove the bottom line down then? What was the pressure point?
It was mainly higher O&M operating and maintenance costs and more expensive generation and fuel. And this wasn't just a one-off thing like a big storm. It's those ongoing supply chain issues and just the higher cost of running their plants to meet this new demand.
So we have this clear earnings miss, but the stock actually ticked up on the day of the call. It was up, what, almost a full percent?
Yep, about 0.9%.
Which is a classic signal, right? The market was looking straight past the short-term friction. They were focused on the huge forward vision.
It's a textbook revaluation. The Q3 issues were noted, but they were just completely overshadowed by the catalyst management laid out. It just fundamentally changes the whole risk-reward picture.
And that catalyst brings us right to the heart of this deep dive, the main theme, data centers. They are changing absolutely everything for LNT.
Management kept calling it the Alliant Energy Advantage, and they gave us a number that is just, it's defining this entire transition for the utility sector.
Okay, what's the number?
LNT now projects an industry-leading 50% peak demand growth by 2030.
Wait, 50? 50?
50% off of 2024 levels. I mean, for a stable utility, you're usually hoping for maybe 1.5%, 2% annual growth. 50% in 6 years is. It's tech infrastructure growth, not a Midwestern utility.
That is just massive. And they're not just guessing this is coming, right?
Not at all. This isn't speculation. They have 3 gigawatts of contracted data center demand already locked in.
3 gigawatts.
Locked in. That includes a big deal with QTS in Madison and a new agreement with Google in Cedar Rapids, who, by the way, is actually pulling their load ramp forward. They want the power sooner.
And the strategy here is smart. They're focusing on what they call plug-in ready sites, right?
Exactly. Sites that are near existing transmission, that minimizes the need for giant, expensive new power lines right away and, helps them get earnings from this growth much faster. They've really de-risked that initial pipeline.
Okay, but that level of growth requires an incredible amount of capital. So, of course, they announced a huge hike to their capex plan.
A huge hike. The 4-year plan for 2026 to 2029 was raised by 17%.
17.
To $13.4 billion.
Wow. And that $13.4 billion is what underpins their growth estimates.
That's right. It supports what they're estimating is a 12% compound annual growth rate in their rate base, plus what's called construction work in progress, or CWIP.
Okay, so clarify that for us. Rate base is the assets they earn a return on. What does adding CWIP mean for the bottom line?
CWIP is, it's a huge advantage for them. It means under their specific roles in Iowa and Wisconsin, they can start earning a return on the money they're spending before the new plant is even running.
So it minimizes that regulatory lag.
It minimizes the lag, and we're already seeing them execute. In Q3, they finished 175 megawatts of battery storage projects and did some key upgrades to their gas plants. They're moving.
Okay, let's pivot to the forward guidance. because this is the stuff that really got investors excited and powered that stock move.
But absolutely. This is the real story. So for 2025, they narrowed their guidance to between 317 and 323 per share. And they said they're trending toward the upper half of that.
Okay, solid near-term clarity. But what about 2026?
That was the big news. They initiated 2026 guidance at 336 to 346.
Which, if you run the math, that midpoint is about 6.6% growth. That's a good bit higher than their typical, 6% long-term target.
It is. And it gets better post-2026. So looking at 2027 through 29, they expect that growth rate to accelerate even further. They're saying 7% plus, and the chatter on the call suggested the floor is really more like 7 to 8%.
But this kind of growth, this $13.4 billion capex plan, it raises the really painful question of funding and dilution.
The big one.
If the rate base is growing at 12%, but EPS is only growing 7 to 8%, where's that other 4 to 5% going? That's a big hit for shareholders.
It is, and that is the central trade-off here. The plan requires $2.4 billion of new common equity through 2029.
$2.4 billion.
They have about $1.6 billion left to raise. So yes, dilution is the primary reason for that gap between the 12% rate base growth and the 7 to 8% EPS growth.
So how are they going to raise that without just tanking the stock price?
They're being pretty disciplined. They're using their ATM facility, their at-the-market program.
Which means they can sell shares into the market over time, not in one giant block.
Exactly. It's much less disruptive. And they're targeting a consolidated equity ratio of 40 to 45% to keep their credit ratings solid. That includes using some clever hybrid credit instruments to help strengthen the balance sheet.
And what about the dividend? Are they sacrificing that growth to pay for capex?
They're pacing it carefully. The 2026 dividend target is a 5.4% increase, which is intentionally below that 6.6% EPS growth.
So they're holding cash back.
They're holding cash back to help fund these projects internally. It shows a lot of discipline.
Now, let's get to maybe the most important part of this story. The reason investors were willing to look past the miss and the dilution risk, and that is the regulatory environment.
The ultimate key. For utility, your regulators have to be on board for a plan this big.
And they seem to be.
They are. They scored a huge win in Wisconsin. The commission there approved a unanimous rate settlement for 2026 and 2027.
Unanimous.
Unanimous and for 2 years. That provides incredible financial visibility for them. It's a green light.
In Iowa, where most of this data center growth is happening.
The framework there is also very constructive. It provides certainty for them to earn their authorized return, but the really attractive part is this optionality for upside benefit sharing.
Meaning, if they do better than expected, they get to keep some of the profits.
Exactly. It minimizes regulatory lag and lets them really benefit from this explosive load growth.
So what are they actually building? What are the dockets in front of regulators right now?
It's a diverse portfolio. In Iowa, they've got requests in for up to 1 gigawatt of new wind,
A full gigawatt.
720 megawatts of new gas turbines, and a smaller gas RICE unit. It's that mix of renewables and dispatchable gas you need to backstop data centers that demand 247 reliability.
And the pipeline for future growth sounds like it's still huge.
It is. Management confirmed they are in active talks for another 2 to 4 gigawatts of load.
On top of the 3 they already have.
On top of the 3, and they were clear these are very high quality hyperscalers or collocators. They're very confident they can land them.
So to put this all in context for you listening, this capex supercycle is happening across the industry. AEP is raising their plan to $72 billion. But L&T's 50% peak load growth outlook, that puts them right at the top of the class.
It does. They are transforming from that steady, slow 5 to 6% grower into a real accelerating compounder, and they're using their location and regulatory setup to do it.
All right, let's wrap this up with our segment where we look at what might happen next. And the usual reminder, this is for entertainment and discussion only. We are not recommending any trades.
Right, purely speculative. But based on everything we've talked about, I'm pitching a 2-year trade idea. Go long L&T.
Okay, long L&T. The plausible part seems pretty clear.
It is. The demand isn't a guess. It's 3 gigawatts of contracted load. That supports the $13.4 billion capex plan and that 7 to 8+% EPS growth target, even after dilution. It just fundamentally changes how you should value this utility.
Okay, so that's the plausible part. What's the outrageous twist? What makes it a trade?
The outrageous twist is betting on the speed of execution. Right now, The market is very focused on that $2.4 billion equity raise. The risk of it?
Sure.
The outrageous bet is that the constructive Iowa regulatory framework, combined with customers like Google pulling their demand forward, will let them offset that dilution risk much faster than anyone is modeling right now.
So you're betting that execution certainty in Iowa and Wisconsin is going to beat the financing skepticism in the market.
Precisely. You're betting the market will have to re-rate the stock as a true 7 to 8% grower, and that those $70+ price targets get pulled forward and pushed higher much faster than expected within the next 18 to 24 months.
That is a compelling bet. They have the pipeline, the regulators seem on board, and the customers are literally asking them to move faster.
That's the trade.
So the key takeaway for you, the listener, is this. L&T is not your grandfather's slow-moving Midwestern utility anymore. This is a high-growth company driven by the AI-era electrification trend. The 17% capex hike and that 50% load growth target, that's all the proof you need.
And here's the final provocative thought I'll leave you with. Management is confidently targeting that 7 to 8% EPS growth after all the dilution. The big strategic question now is, can they build everything fast enough? And can regulators let them pass those costs through to the rate base fast enough to actually hit that return? Or will there be political pressure over rising customer bills before those data centers are fully paying their share?
A race between the speed of technology and the politics of price. A great place to leave it. Thank you for joining us on the Deep Dive. You've now got what you need to analyze this story further. We'll see you next time.